All right, Tim, how we doing today? Welcome back.
Good to see you, Mitch. Thank you. Happy Monday to you both.
Definitely,
Where's Joel?
definitely.
Where's Joel? Did he
Joel,
yeah,
Joel took the day.
alarm clock problems or
Yeah, no,
Hard
he actually had a
weekend.
family.
overslept?
He had
Oh
a
no.
family member an aunt that passed away.
Oh,
So
I'm
I
sorry to
believe
hear
he's
that.
yeah.
Yeah,
So
so he'll be out today. No worries. He'll be back with us tomorrow, like always.
Okay.
But we'll have him back. Let's get to the market action. Of course, one thing that you were telling us, I think even a week or so ago, that we were finally starting to see a little bit of a turn. Now, I think one of the things that we need to really be thinking about is which direction do we go from here, right? Tell us,
Right.
what does market structure Ed say, at least?
I'm giving him some props because you were being cautious going into the last
Yep.
week or two here.
Mhm.
And Tim, caution was the key here because we come off substantially last week. It was not a good week for the markets. Is there a reason to, get a little bit more bullish here yet, or still exercising some caution?
Well, I think that traders should think about the sort of the cadence and calendar of the market. I talk about context all the time. There are three big things that matter to me. What is broad sentiment doing? So what can we see the supply demand balance in the big money that flows through the market and really determines what direction it goes? Then are there things occurring like earnings and options expirations and so on? And then you look for divergences. And the combination of those three things will tell you a lot about what the market's likely to do. So that's a market structure view, but that's how I think about it. And to me, the data it's startling what the data show. And I'll show you what I mean here.
This is let's look at the nitty gritty.
This is what I do. I will look at this every day. And the first thing I'll look at is where is broad sentiment? And if you think about it, look, there are all kinds of ways to measure the market, but this is a simple way. I'm a simple guy. It's a 10 points. It's a 10-point scale. So to have demand that will cause prices to generally rise, this number needs to be above 5.0. Well, it's not. So you know that the market is going to have a bias to weakness if that number is below 5.0. And like I said, it's just a measure, but it's an algorithm that meters buying and selling under the market rules to see which direction things are going. It doesn't matter whether prices close up or down. It's really how they close relative to midpoint, because the rules of the market force prices toward midpoint. And so as the number of days that things close above midpoint declines, tells you there's a bias towards selling. So that's one side of weakness. And then I come down and look at the supply side. Demand side, falling. Supply side, well, on Friday, the short volume in the S&P 500 reached nearly 51%. So the market is more short than long. Mm-hmm. So it's much more difficult for prices to rise. Context, index futures used by trillions of dollars to hedge exposure to the market expire tomorrow. So either side of that can be volatile. You can have a strong update. I bought things on Friday because I believed that the market would be up today, no matter what the economic data, but because there will be an effort to move prices toward a midpoint when index futures expire tomorrow. So then one side or the other, the market will be up. It's a gamble. I thought, well, based on the market activity on Friday, so I bought a market hedge on Thursday, a short S&P 500 hedge. When the Dow was down 470 points, I sold it. That was my only gainer. And I bought KMB and I bought Crocs, one out of low volatility and one out of momentum. But here's the thing, folks. So when we're with Edge, we measure whether there's an upside opportunity or an opportunity to make money when big dollars cluster in things that don't move much. That's low volatility. Well, look at the number of components. That's very, very telling. There are 5 in low volatility. It just means that across the whole market, there are very few securities that offer the kind of sort of safe harbor that big money would look for. And then look at momentum. There are 2. That is it out of the entire market.
What are the 2? I think that's the same one from last. Wasn't Coke one of them?
No, that would be a low volatility.
Oh, that's a low volatility.
So there they are. They're
DraftKings. The DraftKings.
And DraftKings. Yeah,
and its momentum's starting to slow.
Swung that short, baby.
They're They're not great, but see, the reason that we point these out is there is this kind of opportunity to make a gain. We look at volatility. How much do prices move intraday over an average period of time, a week? And so you'd say, well, if DraftKings is down Friday 3 or 4%, there is a good chance today that you can make 3 or 4% because that's taking half of the volatility. So those are things that you can use. I bought Crocs for the same reason. It's already out of that portfolio. If I'm looking at Crocs here, and here's how I know, and I want to show you one more thing because I think it's telling. So I bought Crocs because demand was rising and supply was falling. They're already breaking down. So I will leave that today. You just have to take what the market gives, folks. It doesn't matter how much something goes up if it goes back down before you sell it, right? So you have to be aware of those things.
Tim, what do you do? And we never talk about this much, but how do you manage your losers? Because obviously, as traders, we all have losers all the time, and in some cases, I'm sure you can see, lower supply and rising demand, and the stock price actually goes down. It doesn't work on 100% of the time. How do you manage your losers?
By being very careful about broad sentiment, context, and divergence. I try to minimize them. We're all going to have them.
Yeah.
I had one a week ago where I lost about $1,000. That's about as much as I care to lose.
Yeah.
But how I do that is if the supply demand equation has changed, and I'm down in a stock and it recovers some portion of it, I leave. You have to cut your losses. I don't tend to use stops and limits because you miss what the supply demand equation is going to give you. It's meant to be predictive, and prices are very volatile. Supply and demand are not volatile. Prices are. So you can miss out on things by using stuff. And I'm not saying you shouldn't. You should do what works for your risk tolerance. What I try to do is be concentrated in things where I've got the mass stacked in my favor. But one other thing I want to show you here. So here's how I think about this. Here's the long side of the market. The long side, there's almost nothing. This is telling us the long side of the market isn't good. So if I go down to my short beta portfolio over here, and it's the exact opposite. Notice that demand is falling, supply is rising, converging supply and demand, the exact opposite of what you do long. Long, you want rising demand, falling supply. Look at the number in this. So there's 2 in momentum, which is rising demand, falling supply, and 93 in short. Well, there you go. The market is at present, no matter what it does today, and until further notice, a short trade, not a long trade. And I'm not great at that. I use little bit, I aim small, miss small. I don't know a lot about shorting. I use SH principally for that because it's very liquid. But that's what the data tell us at present.
Love it. So definitely we're going to be looking for some possibilities in there. What about the recent strength that we've seen? Of course, in the beginning of the year, we saw the NASDAQ and tech stocks really bounce back. Now it's starting to come right back down. Is this kind of an opportunity, or should it be something that we should be running from?
Well, here's a great example right on the screen. If you look at semiconductors, I've got 15 in my semis portfolio. I enter the tickers. Look at the supply demand equation. That's what you look at. Which way is demand going? Down. Which way is supply going? Up. Until those things change, or at least bottom out, semiconductors are not a great place to be. So now let's go look at the tech sector. Here's the tech sector. So our sample, which is most of that GICS group as identified by the S&P 500, S&P Global, we license that data. Here's demand, dead flat, even ticking down a little bit on Friday. Where's supply? Rising. It's below 50%. It's not terrible, but that is not what I would buy. That is not the place to be. So
what's the number one stock in information technology there?
That's a great thing to do. So let's go look. Let's see what stuff in tech it has strength. And that is exactly what you want to do. So we come in here and I want to sort by demand. Let's go. What's at the top of the list, and maybe then even by dollars per trade. But here are the 10s. And I go look for the most liquid thing that's a 10, and it's the same stock that is in the momentum portfolio. It's already found that for us. So Procore Technologies is a mid cap because we look for things that are liquid, because things that are illiquid, like SNC, Syncor, it trades $350 at a time. You can't get in and out of that stock. It's very dangerous, but you can get in and out of PCOR because it trades $5,500 at a time. But that's about as small as I'll go for those trades. Look, there's not much. And that's kind of how I look at it. $8,300 at Cisco. Cisco's actually a pretty good stock here. And that's what you look for.
Value.
Look for supply, demand.
Value stock.
Yeah,
you can kind of see what they're starting, and we've pulled back here. Cisco is interesting. I had the earnings pop, and again, we have to realize in this market that we're in, buying those rips is just not working. Cisco held up for 2 days after the earnings pop, and look, here it is 5 days later, gives it all back. So now you're coming back to that point of 48. I actually don't mind it down here either, just for the potential bounce aspect of it.
Right, and you're not looking for much, folks. In Cisco, your return opportunity is very small. It's like 2%. But realize, what we tend to do as traders is we think, I want the thing that gives me 100% return. Well, there aren't very many of those. There's a lot more opportunity to make 2%. And if you make 2% a week, you're up 100% in a year.
Yeah, that's a great point. It's how I try to do my trading too here, Tim. It's like I just base hit it. And I'm not even going for 2%ers. I'm going for less than that because I do a lot of index arbitrage and different stuff too. But I do make calls on stocks as well. And I'm never going in looking, I want to double my money on this stock. I mean, we're not in this, and maybe in 2020 it got to that point, Tim, where you had these, penny stocks or dollar stocks or $5 stocks. We're going to 10 overnight. AMC going from 5 to 20 overnight. We're just not in that market environment here anymore.
Definitely.
So if you're looking to double your money in something, you're holding on, and what happens is you get up 10%, and then you're like, oh, you're back down, and you're like, well, why? All of a sudden, I was supposed to go up more, and I gave it all back. What did I do wrong? Well, the environment you're in, and the environment is take the money and run.
Exactly.
Nope. That is expectations, right? Yep. Expectations in the market need to match the belief, right? And I think a lot of that is Tim giving some good lessons there, in that if your expectations to make, 40%, 60% every trade, well, let's just be honest, that isn't probably going to happen, right?
Right. If you've got this kind of demand, so if you go back to the end of the year and demand dropped below 4, so that's a green line. Now we've got a green light saying there's a real strong chance of a bottom here, and this is rising, and then supply has peaked and begins to fall. The probability that you can trade momentum is very high. And you'll have up and down days, but that's going to give you a lift, and so then you can chase momentum. And we don't have once demand peaks and begins to fall right at options expirations, and supply begins to rise, momentum is over. And then you have to shorten your time frames, shrink your expectation of returns. And that's what you do. And you can do fine in any condition, but you have to be patient. When the data aren't there and they're not giving you opportunities, then don't try to chase them. You'll end up just hurting yourself.
Tim, can we jump into just a couple of the earnings stocks and look at, what you're seeing for maybe a potential like Zoom tonight? It's one that they're talking about. So we have, 3 major reports tonight: OXY, which I have a position on, WDAY, and Zoom.
Okay.
So let's go to Zoom first. It's a stock that a lot of retail traders like to trade. It's widely known. Let's see what Zoom says.
It's not great. If I were, I would take. This is what I would do.
The report you're
I would leave it today. If it's up, if it's up 2-3% today, I would leave it. Here's why. Okay, so see, demand has stopped rising, and it's not even back to 5. It's not enough to even hold the bid in the offer. And then supply is rising. Supply is at 65% of the trading volume is short. Here's a long bet. There is a long bet, but it's not very good. So I would look at this and say, all the hedge funds are betting short. Now, they could be wrong. That I could make a case for why Zoom could beat expectations, even if its results aren't great. But this is where you make a decision. I look at the math and say, I'm comfortable being wrong if it's up, like NVIDIA. NVIDIA I would not have owned. And we'll look at Workday and Occidental here in just a second. But if you look at NVIDIA, so, if I looked at NVIDIA before results, would I have bought it? Well, no, because demand was falling. There were some pretty long bets in NVIDIA, but supply was rising, demand was falling. I wouldn't have done it. We edge users did. There were some who had it, but I say they got to take those gains, because the supply demand equation isn't good, and Nvidia is going to decline. That's what this math tell us. So you should know that. If it's up today, look, take your gains. You can always come back and buy it. When demand is screaming at the ceiling and supply falls, you're going to make money. But when those conditions break down, look out. Okay, so Workday and then
Occidental Petroleum, the Warren stock.
One of the great stocks of 2022, the best in the S&P 500. That's better. So Workday actually, so you look at the supply demand equation, below 50% short, demand steady. This stock has a much higher probability of producing sustainable gains, meaning a number of days of gains, than does Zoom. So if you're going to take one, there's the one to take. Then let's look at Occidental. And energy I'm surprised by it. I didn't expect it. It has rolled over and it's turned weaker demand, higher supply. But let's look at, a couple stocks in that group did very well. Again, I would say the supply side is fine in Occidental, but the demand side is falling. Very weak.
We need Warren. Warren, get in there.
Warren.
Right. That's right.
Warren, come save the day.
I know. Come save me on my Occidental Petroleum. Come save me.
What about Target? Target's been sleepy for so long.
We've got a bunch of retailers reporting.
Yeah, they report tomorrow morning. So I've been looking for that huge gap if we're ever going to go and fill that on Target, because we've seen some of these huge gaps. Like there was in Netflix, right? For a while, everyone was like, "Oh, never get back there." Oh, it did.
Well, so it's not great, Mitch. Here's the demand is falling, and while there's a big drop below the trend, this was a huge short here, and it paid. Stock came down from 180 to where is it now? 167. Yeah. And so people have covered their short positions. The trouble is it's still well over 50%. It's 56% short, and demand's at 4.2. I would not own that into results. It doesn't mean, does this set up a recovery? Yes, but I love stocks that are 5 and higher with supply below 50%, because then you have a long bias. Those are much more likely and much more statistically true to deliver gains than this. It doesn't mean it won't, because earnings can change outcomes, but I wouldn't buy it.
I'm nervous on Target too, and it reports tomorrow morning, and I would not want to be long this into the report either. I'm just nervous because retailers, we've seen multiple retailers warning. Now we get, Tim's look, from a quantitative perspective, not looking great here. Ducks kind of in a row. And again, anything can happen. To your point, maybe, your system didn't look like NVIDIA was going to pop, and it did. So it's not always right. Nothing's 100%. Exactly. But I'm nervous on the Target earnings.
Well, I got the hardest one of the day, right? Okay. And this has been one that I tried. I think a lot of people have tried, probably in the chat. The natty gas bottom. When does it happen, Tim? When does it happen? Right now, people have told me in the chat that I could buy air better than I could buy natural gas.
So I don't know how many you track, Mitch. I've got 7 with heavy exposure to nat gas in my portfolio, and I'll take you to it. But this is, there's good and bad. The bad is, look at the supply side. This is 15 of the last 30 days. It's below 5. It's not great, and it's tipped over again. The supply side is better. 47% short, 48% short as of Friday. I don't love that. And I know EQT was the best performer last week. If you look at EQT, it's 7 out of 10 and rising, 48% short. 30-day trend is down. That's what that means. This will tell us a 30-day trend in the supply side. It's okay. But look at this weakness. You got 1s, 1.8, 2.6, 3.4, down, 4.4 down. That's a 30-day trend. I don't love it. I'm not there yet. There are much better things to look at, such as cash.
Cash is king, baby. Right. Cash is king.
Right.
I'm long cash.
Me too.
I'll borrow some cash. All right. Like always, you guys can keep up with everything that Tim Quast does. And of course, check out Market Structure Edge for yourself. You guys can be running through all of this. Get your free trial. You can get up to a month just without even a credit card. And you guys can use the promo code, of course, Benzinga. Is it Zynga or is it Benzinga? I'm pretty sure
it's Benzinga, all
Benzinga.
Caps. That gives you a monthly. Baby. It doesn't work for a yearly. It works for a monthly. But monthly, that'll give you
check it out.
$40 off. It's a very good deal. It's the best deal we have. Yeah.
Well, there you have it. Like always, Tim, we always glad to have you on. We took a look at all different types of the market. We'll definitely bring you back next week. Have a good one,
Look
Tim.
forward to it. You guys too. Have a good week.